Welcome to Dinar Today. What we're covering in this episode is not hype, not rumor, and not wishful thinking. It is a real structural development that could significantly reshape how the Iraqi dinar is held, moved, exchanged, and eventually used in the global digital economy. If you've been holding dinar for years, or if you closely follow global payment systems and currency integration, this is an update you need to understand clearly, carefully, and without emotional bias. In this report, we will walk step by step through what has actually changed, why it matters, what it does not mean yet, and how to approach this moment responsibly. By the end of this episode, you will have a realistic framework to separate signal from noise, opportunity from risk, and preparation from speculation. Let's start by setting the stage properly, because confusion thrives where definitions are unclear. When we say a currency is entering the digital economy, we are not saying that it has suddenly become a global reserve currency or that it has revalued overnight. What we mean is that the currency is becoming accessible through mainstream digital payment infrastructure. That includes global wallets, payment processors, internal ledger systems, and peer-to-peer platforms that allow people to hold balances, move value digitally, and convert between currencies without relying exclusively on physical cash or informal intermediaries. This is a foundational shift. It does not create value by itself, but it creates access. And access is what allows value to circulate. For the Iraqi dinar specifically, this kind of digital access represents a major departure from the past. Historically, dinar holders faced friction at every step. Physical notes, limited exchange points, long settlement times, opaque spreads, and inconsistent acceptance created barriers that discouraged legitimate use. Digital pathways changed that dynamic. They introduced liquidity, speed, and visibility. Liquidity means you can convert or transfer value more easily. Speed means transactions happen in hours or minutes instead of days or weeks. Visibility means more participants can see, price, and evaluate the currency. But it's important to understand that liquidity cuts both ways. It creates opportunity, but it can also introduce volatility. More access means more activity, and more activity means price movement can become sharper in both directions. Now let's talk about what has actually changed on a technical level. Over recent weeks, global payment platforms and financial service providers have updated internal systems to recognize and process additional currencies. When a major digital wallet or payment processor lists a currency in its supported currency tables, fee schedules, or conversion tools, that is not a marketing gesture. It means the platform has completed back-end compliance checks, rate sourcing, settlement logic, and risk modeling for that currency. In plain terms, the system knows how to price it, move it, and account for it. That does not automatically mean full global functionality is available everywhere, but it does mean the currency now has a pathway into the platform's ecosystem. For dinar holders, this is significant. Seeing the Iraqi dinar appear as a supported or recognized currency indicates that the platform can quote exchange rates, process conversions, and potentially allow internal transfers between accounts. In some cases, users may be able to hold a dinar-denominated balance, send that balance to another user on the same platform, or convert it into a more widely used currency like the US, dollar or euro, with fewer intermediaries than before. That reduction in steps reduces cost, reduces error, and increases transparency. However, every platform has different rules depending on country, account type, and regulatory jurisdiction, so assumptions are dangerous. Verification is essential. Let's address PayPal-style global wallets specifically, because this is where much of the attention is focused. When a global wallet recognizes a currency, it usually means users can see that currency in conversion tools, internal ledgers, or settlement options. Practically, this can allow someone to receive value denominated in dinar, convert it within the platform, and then use the converted balance to pay merchants or withdraw to a linked bank account. What matters most here is settlement behavior. Some platforms allow direct settlement to banks in the original currency, while others settle in an intermediary currency. That distinction affects speed, fees, and tax reporting. Always read the platform's official terms and fee disclosures before moving funds. Now let's clear up confusion around Venmo and similar peer-to-peer apps. Venmo itself remains primarily a domestic, US-focused P2P service. However, it is part of a larger ecosystem. As parent companies unify wallets, ledgers, and back-end systems, value can move more fluidly across services. This does not mean Venmo suddenly supports international currency conversion in the same way a global wallet does. What it means is that interoperability is increasing. For users, this may show up as easier transfers between related services, smoother balance movement, or fewer conversion steps when interacting with users on connected platforms. The key takeaway is this: always distinguish between the capabilities of a specific app and the broader ecosystem behind it. Peer-to-peer access is the next major piece of this story, and it deserves serious attention. P2P systems allow individuals to exchange value directly, often using digital balances, escrow mechanisms, or reputation systems rather than traditional banks. When a currency becomes accessible through P2P channels, liquidity increases because buyers and sellers can meet directly. That often narrows spreads and speeds up settlement. For dinar holders, this means more potential counterparties and fewer geographic limitations. But P2P also increases risk. Without regulated intermediaries, responsibility shifts to the user. Escrow, identity verification, transaction history, and platform reputation are non-negotiable safeguards. Never trade directly outside a system that offers protection. From an investor's perspective, increased accessibility improves market efficiency, entry and exit become easier, price discovery improves because more participants contribute real bids and offers. That can make the currency more credible as a medium of exchange and, over time, as a store of value. But let's be absolutely clear. Digital access does not guarantee revaluation. Revaluation depends on macroeconomic policy, government decisions, fiscal discipline, reserves, and international confidence. Platform support is an enabling condition, not a trigger. Treat it as infrastructure, not prophecy. Risk management is essential here because increased accessibility attracts bad actors. Scams thrive during transitions. False revaluation promises, fake exchanges, and pressure-based offers are already circulating. The rule is simple: no legitimate platform guarantees profits. No real revaluation is announced privately, and no trustworthy exchange requires you to bypass escrow or send funds blindly. If someone promises certainty in an uncertain market, walk away. Verification beats speed every time. If you want to engage this new environment safely, start small. Open accounts only on official platforms. Complete identity verification honestly. Read the fee and settlement pages. Perform a small test transaction that you can afford to lose. Document every step. Enable two-factor authentication. Test withdrawals to your bank before scaling up. This process reveals hidden fees, delays, and limitations without risking large sums. Discipline now prevents regret later. Merchant acceptance is the next frontier. When wallets support a currency, merchants can accept it more easily if their processors handle conversion. For businesses, this opens access to new customers, particularly diaspora communities and international buyers. But merchants care about predictability. They need fast settlement, clear reporting, and manageable fees. Widespread adoption requires tools that make accepting dinar as simple as accepting any other currency. That takes time, but digital integration makes it possible. Regulation cannot be ignored. Cross-border currency movement triggers reporting obligations, AML checks, and tax considerations. Platforms monitor transactions closely, and unusual activity can freeze accounts pending review. If you plan to move significant sums, consult a tax or legal professional familiar with your jurisdiction. Compliance is not optional, and ignorance is not a defense. The question everyone asks is whether this means revaluation is imminent. The honest answer is no one knows. Digital access improves visibility, participation, and liquidity, which are supportive conditions. But official exchange rate changes come from policy, not platforms. Plan for multiple scenarios. Never risk capital you cannot afford to lock up or lose. Security deserves one final emphasis. Use strong passwords, unique emails, two-factor authentication, and account alerts. Avoid storing large balances on platforms long-term. Control your keys where possible. Treat digital convenience with the same seriousness you would treat physical cash or property. As we close, here is a practical roadmap. Verify official platform support in your country. Run small test transactions. Use escrow and verified platforms for P2P trades. Secure accounts aggressively. Keep records. Consult professionals for large moves. Digital access expands options, but discipline determines outcomes. This is not the end of the story. It is the beginning of a new phase. At Dinar Today, we will continue to track real developments, not rumors, and provide clear analysis so you can make informed decisions. If you found this update useful, subscribe, share, and leave your questions below. A follow-up episode will break down tax and regulatory implications by region. Stay informed, stay cautious, and I'll see you in the next update.